We all use banks pretty much every day. But have you ever stopped to ask how they actually work? Well, in this explainer, we're going to pull back the curtain and take a look at the hidden architecture of the entire financial system. Let's get right into it.
We're starting with this quote because, honestly, it gets right to the heart of the matter. It's kind of like a puzzle, isn't it? It hints that there's this story we're all told, and then there's what's really going on. And today, we're going to solve that puzzle together.
All right, so to get to the truth, we first have to talk about the myth. This is the version of banking that, most of us picked up somewhere along the way. It's super simple, it's intuitive, and it's also not really the whole story.
The story usually goes something like this. A bank is just a safe place, right? A kind of go-between. You have some extra cash, so you put it in the bank for safekeeping. Somebody else needs cash, so they go to the bank to borrow it. The bank is just the helpful middleman in all this.
And this is that mythical flow we all imagine. Step 1, savers put their money in. Step 2, the bank pops it in a big vault. And step 3, the bank lends that very same money out to someone else and makes a little profit on the interest. It seems so logical, right? The bank is just moving existing money from one person to another.
But what if that simple, neat picture is missing the single most important detail? What if banks aren't just moving money around? What if they're doing something way more powerful?
Okay, so let's go ahead and crack that myth wide open. It's time to see the real machinery at work.
And here it is. This is the one sentence that turns the whole story completely on its head. Banks do not wait for someone to deposit money before they make a loan. In reality, the act of lending actually comes first.
So this really sets up the two completely different ways of seeing a bank. On the one hand, you have the myth, banks as these passive intermediaries just passing money along. But then you have the reality, banks as active creators. They don't just handle money, they literally create it.
And that brings us to the core of our whole explainer today, the birth of new money. We're about to unveil that hidden architecture and see exactly how a bank can just, create money.
Now, this is the question you're probably asking yourself right now. If you go get a huge loan for a house, for example, where does all that money actually come from? If it's not from another saver's account, then where?
And the answer is, it doesn't really come from anywhere in the way we usually think about it. That image we have of a giant vault filled with stacks of cash that gets handed out to borrowers? Yeah, that's not what happens.
The bank creates it, poof, out of thin air, with just a few keystrokes on a computer. When a bank approves your loan, it just types the numbers into your account. And in that very instant, new money has just entered the economy.
Now, the technical term for this is loan creation. It's pretty straightforward. The bank creates a loan, which is an asset to them because you owe them that money back. And at the exact same time, it creates a matching deposit in your account. That deposit is a liability for the bank because now it's your money and they owe it to you. The key is the loan and the deposit are born at the exact same moment.
And this is what happens on the bank's books, their balance sheet. Before the loan, you've got their existing assets and liabilities. But after the loan is made, both sides of the sheet just expand. A new asset, the loan, magically appears, and a new liability, your brand new deposit, appears right alongside it. Nothing was moved, the balance sheet just got bigger.
Okay, so banks can create money. You might be thinking, that's a neat accounting trick, but so what? Why does this matter to me? Well, it matters a great deal. This isn't some obscure financial secret. It's the fundamental engine of our world.
Because this ability to create money, basically on demand, is what fuels, everything. It's how new businesses get off the ground. It's how new houses get built. It's how our economies expand. It allows spending to happen right now, based on a promise of future value, without having to wait around for a big pile of savings to build up first.
But, like any powerful engine, it's got two sides. On one hand, it is a phenomenal engine for growth. It injects money and spending power into the economy right when and where it's needed. But on the other hand, this incredible power also creates risk. If way too much money is created way too quickly, it can lead to financial bubbles and serious instability. And if you want to get a sense of the sheer scale of this, just consider this number. In a modern economy like the UK, something like 97% of all money isn't physical cash or coins. It's digital money in bank accounts, money that was created in exactly the way we've just described. That is a staggering reality.
So we'll end with this one question for you to think about. If almost all the money that exists in our economy is brought into being at the very same moment a debt is created, what does that really tell us about the relationship between money and debt?
It suggests they're basically two sides of the same coin, and that debt isn't just some byproduct of our economy, but is fundamental to its very architecture.